Georgi, let me once again thank EBRD and all the other international financial institutions that have shown an unprecedented support to Georgia during the pandemic and beyond, and continue to do so.
I join my thank you as well, and fantastic job, great job, Elena, on this exclusive, where business media and Ms. René Basso is a very high-ranking respondent for us, especially. Thank you again for this chance and opportunity. Thank you, Elena.
Thank you, Georgi. And we can now turn to the story that we at BM.GE English started to explore, and it concerns the current downgrade of the government support component for Georgia's three systemic banks, meaning Bank of Georgia, TBC Bank, and Liberty Bank. You will probably agree with me, Georgi, that especially during the pandemic, the soundness of the banking sector is of crucial importance for Georgia due to its dominance on the background of underdeveloped capital markets on the one hand, and on the other due to the fact that Georgia's banking sector is highly concentrated, exactly with these three largest banks accounting for 79% of assets, 81% of deposits, and 78% of loans.
Fully agree. Of course, Elena, a downgrade coming from the influential rating organization is always an important thing to understand, and especially during the crisis like no other, as we often call this pandemic. So let us first see what was the reasoning behind this downgrade in the government support ratings that Fitch Ratings released last week.
We believe that this legislation, combined with constraints on the ability of the authorities to provide support, mean that government bailouts, although still possible, can no longer be relied upon.
Georgi, what seems to be the most important argument in Fitch Ratings' recent report is the high dollarization of the banking system. As Fitch Ratings believes, the ability of the authorities to provide support is limited primarily because of the high dollarization of the banking system, with 62% of total liabilities being denominated in foreign currencies at end 11 months 20, what Fitch Ratings was looking at. The banking system's FC liabilities of USD 9.4 billion exceed the national bank's foreign exchange reserves of USD 3.9 billion. As a result, Fitch sees a significant risk of banks' need for government support coinciding with heightened constraints on the ability of the authorities to provide it due to stress in the country's external finances. This argument stems from one of the basic pillars of the resolution framework itself, which assumes that there should be no creditor worse off under the resolution regime than it would be under liquidation. And although he understands the thinking of Fitch Ratings behind the downgrade, it is not sufficient to the vice governor of the NBG. We can now listen to Papuna Lezhava's arguments. Mr. Lezhava, thank you for taking our questions and talking to the checkpoints. You know that Fitch downgraded three Georgian banks' support ratings on resolution framework recently, and they explain it that this resolution framework means that government bailouts, although still possible, can no longer be relied upon. What would you answer Fitch Ratings from the checkpoints?
Thank you for your interest, Elena. Let me first explain what this rating means. So this is a support rating that is a sub-component of overall assessment of bank ratings. It has no impact on the overall rating of the banks because the viability rating, which is a standalone assessment of a bank, is higher than the support rating. And the overall rating will be determined by the higher of the two. So this assessment was not performed on specific banks. It was the assessment of the government support probability, and Fitch thinks that government support is lower, but it's not impacting the overall rating. Now, it is important to note that this assessment of Fitch is somewhat different from other market players, including Moody's, for example, who state and believe that this reform has reduced the contagion risk from bank to bank. It has reduced the loss probability for creditors, and government support still remains high. Probability of government support. This is quite different from what other rating agencies and
very different
state. Yes, let me also say a couple of words about resolution reform, what it entails, and what are our expectations, how to use it. So first of all, this reform was in the plan, in the roadmap years ago, already in 2015. International Monetary Fund gave us the recommendation to work on this reform. So it was a scheduled reform, and it did not. It was not triggered by a certain event or a pandemic. It was started much before. The idea, the main goal of the resolution framework is to create an alternative for banks' liquidation. So in case of a failure of a bank, there is no systemic risk, and there is ability of a regulator to maintain the critical function of that bank in the financial system. And one of the main basic pillars of this regulation assumes that there should be no creditor worse off under the resolution regime than he or she would be under the liquidation. Now, what Fitch's assessment is based on is, on one hand, this reform, and on the other hand, high dollarization of Georgian banking sector. And Fitch states
which is not a new thing either, right? This is not a new thing either. High dollarization rate.
Yes, dollarization is not new, but this is the thinking process that Fitch is going. But to counter that argument, there are a few things to be considered. First, as you mentioned, dollarization is not new for Georgia. It has been here for years, and we'll be mentioning about its challenges. Second, before the adoption of this regulation, government support was illegal. So Georgian government was not able to invest in the equity of the banks. Third, before the adoption of the resolution framework, there was no alternative to the liquidation regime. Now, this framework creates a new alternative of liquidation. And finally, compared to the EU regime that requires bail-in of the creditors, which means either the write-off of the debt or conversion into equity. We do not have such requirement. So we can use the government fund before the creditor takes any loss.
Okay, my last question, since this is still called downgrade, although it is a bank support rating, but still this word during the pandemic is quite harsh. You would agree. So would that affect in any ways, from the standpoint of the regulator, investors' trust into these three systemic banks?
Mm-hmm. We believe that this will have no major material impact on investor views, and this is because of several reasons. First, this rating does not reflect on banks' standalone rating. It is the support rating, which is a subcomponent, and the overall soundness of the bank is not. Second, the investors of our banks are quite sophisticated. They know this reform. In many cases, these investors are IFIs, international financial organizations, who have themselves positively assessed this reform. And finally, the assessment of Fitch is not in line with the assessment of other reputable players such as Moody's, IMF, and others. So all this makes us think that overall, this report will have no material impact.
Thank you so much, Vice Governor, for answering and taking our questions. Thank you.
I'm really glad and good to see that NBG is openly communicating on this issue. Now, what about Fitch, Elena? Now, what is their approach to the last point that you have emphasized with your question to the Vice Governor about the impact that this particular downgrade can have on investors and on the banking sector itself?
Thank you for that question, Georgi. We have, of course, approached Fitch Ratings Moscow office for more details. Unlike NBG, Fitch Ratings politely declined from the recorded interview, but agreed to take my questions and send answers in a written form, stating that its directors had nothing more to say other than what was already written in the released document. To make a long story short, we received Alyona Grenenko's comments. She is the director of Fitch Ratings. This is is what she wrote. The rating action has no impact on our assessment of the soundness of the Georgian banking sector, as it considers only support ratings and support ratings floors, which reflect our view on the likelihood of extraordinary support banks could receive from the authorities in case of need. In her written comments, Alyona Agrenenko, director of Fitch Ratings, also assesses the soundness of Georgian banks, which shows that most probably such extraordinary support won't be needed, at least in the nearest future.
We expect that revenues of the banking sector would improve in 2021 against the backdrop of the economic recovery and stronger credit demand. Banks have created significant preemptive provisions in 2020 against potential pandemic-driven asset quality weakening, reducing risks that banks will need to create high loan impairment charges in 2021 and incur losses. Thus, we expect sector bottom-line profitability to be stronger in 2021 compared to around break-even result in 2020. At the same time, we believe that sector asset quality could deteriorate in 2021 as a result of the lagged impact of the downturn in 2020. However, we think that banks' pre-impairment profitability buffer would be sufficient to cover for potential losses without putting pressure on capital.
Elena, could you be so kind to clarify one more point for our viewers? Papuna Lezhava said that this is not the only assessment of the banking resolution framework. Please elaborate a little bit more on this.
Yes, Georgi, BM.GE of course, fact-checked Vice Governor Papuna Lezhava for his comment. What we found so far on the issue is that in April 2020, Moody's upgraded the government support rating for the same 3 systemic banks, and here is what they said.
Georgia's largest banks benefit from government support rating uplift. We consider that there is a high probability that government support would be provided for senior creditors of the 2 dominant Georgian banks, namely TBC Bank and Bank of Georgia, and that there is a moderate probability of support for the 3rd largest bank, Liberty Bank. The upcoming resolution regime does not change our views on government support. It strengthens the resolution powers of the National Bank of Georgia and modernizes the resolution framework, bringing it largely in line with the European Union's BRRD and international best practice. It will help contain contagion, reduce disruption to bank clients and markets, and potentially help reduce losses for creditors.
Also, Georgi, let me add here that in May 2020, after the completion of the 6th review under the Extended Fund Facility and the approval of the request for augmentation of access to support Georgia address the COVID-19 pandemic, International Monetary Fund welcomed the NBG's proactive monitoring of the impact of the crisis on asset quality in coordination with the banks, while also making further progress in implementing the resolution framework. This is a direct citation of the IMF. Fitch's assessment is not the only approach to the banking resolution framework, and since other reputable players such as Moody's and IMF have totally different analysis, BM.GE finds it interesting to research this issue further and give our readers and viewers more assessments of independent experts and analysts, hopefully already next week.
Hey guys, stay tuned, subscribe and follow us on BM.GE.